By understanding and mastering your finance, it opens up many doors, right? My goal is for you to leverage business funding to invest back into your business so that you can use your tax returns for future funding. Yeah, it's okay if we have to go and start off with the no doc or low doc programs. There's a lot of different hacks that we can move around. But if we're into a point where we're able to structure our income and revenue so that the banks can use our tax returns, right? Then it just opens up additional doors with a lot of these banks. And by going through this process, it actually makes you a smarter business owner, right? Understanding your finances, how they work, cash flow, profit losses, and balance sheets. A lot of this element, they don't teach this kind of stuff, honestly, in school. And especially for the element of implementing that for your business funding. So this actually makes you smarter by understanding what we're teaching guys in these master classes. Besides that, the benefit of leveraging your financials for credit hacking, right? Knowing your current financial picture allows you to make smarter decisions in the future. Wouldn't you agree? Right? If I know exactly what my cash position is right now, and I need to make a certain purchase, what's the cause and effect of that? Right? In equipment, hiring that person, inventory. If you're buying that inventory and you're left with zero operating cash, right? It's gonna put you into a bind. Sometimes we have to understand where we're currently at. So the financial picture of that makes a big difference. Now, this is how I mastered the art of financials, right? Throughout my career, I was in the mortgage industry. I dealt with literally about 3, 4, 5,000 files, right? From personal tax returns, from credits. That's how I really got proficient in the credit industry. I hired bookkeepers, working with them for my own taxes. I understood by asking a lot of questions on how they were doing what they're doing, right? Whenever I hired somebody, I never just let them do the work. I sat next to them and asked, I'm like that annoying kid in the back of the car saying, "Are we there yet? Are we there yet? Are we there yet?" Because I didn't go to college. And so I hired people, and that's how I learned master of a lot of these talents that I know today, right? YouTube University. I listen to audiobooks almost every day. I applied all this into my own business, and that's how I got acquired, all the business loans, and then I use that to help my clients and implementing that, right? When you do this thousands of times, you're getting pretty good at this. And applying this is how I got that 1.3 million. And so to be a credit hacker, you have to think like a banker. If you know the rules of the game and you can apply that to yourself and understand and forecast what they may like or dislike, it can help you optimize that whole element. All right, so let's go ahead and get started off. Why we need the info and obtain the information from tax returns and the financial statements. Number one, we have to understand what your company is, right? If you're a sole prop, an LLC, an S Corp, C Corp, how you're structured has different tax implications and how you're able to really carry things over from the business to the personal, right? Very beginning, we have the sole proprietorships, right? Little pros over here. They're very cheap to set up. You don't need to invest hundreds and hundreds of dollars, $20, $30. You get your fictitious business name, register with the state. You can obtain an EIN, right? That's free instead of using your social security number. You have one tax return, right? You just add your Schedule C, and that's pretty much it. Cons is that your personal assets are at risk, right? If you get sued, you're not protected by what they call the corporate veil. Your LLC, your S corps, it's like a person, it's an entity, and it shields you from your personal assets, right? If you have a home, car, assets, anything of that nature, if something goes wrong, they can pierce the corporate veil and go after you, right? But you don't have that if you're in a sole prop. Also, the lender's perception could be that you're a very small company.
Mm-hmm.
I don't know if you knew this, but you're actually at a higher chance of getting audited by the IRS from sole props.
So first, can they get business funding as a sole prop, and then tell people why they're more likely to get audited as a sole prop?
Yeah, the answer to the question is definitely they can still get funded as a sole prop.
Mm-hmm.
Revenue is revenue, income is income, credit is credit.
Mm-hmm.
If I'm a sole prop and all of a sudden I hit a wave and I'm able to bring in $50,000 to $100,000 a month, and even though I am a sole prop and I have a business and everything's still set up, corporate compliance, everything is there, Is a bank going to look at me? I'm sorry, we're not going to fund you because you're a sole prop. No, the answer is no. Right. And so it still is revenue, but again, it does make you look like a smaller person. And that's the other reason why the IRS will go after you, because you don't have the financial resources typically as a sole prop to fight them.
Mhm.
Right. And that's why, in my opinion, why the IRS likes to go after the small people versus the bigger ones, because the team of lawyers and CPAs and things of that nature, you can afford that typically if you're a bigger organization. However, if you started off a sole prop, it's okay. You can still convert your sole prop to an LLC, right? You can still retain the age of your company, XYZ Enterprise, right? Sole prop. And I registered that 5 years ago and have been operating under XYZ Enterprise. And all of a sudden, I want to convert that now to an LLC. As long as you kept the same name and you're operating, from that, and you have proof, you can just simply update your SS4, your IRS EIN online from a conversion. And if the name of that company is also available with the Secretary of State, right, as an LLC or a corp or anything. But it's very key that you have proof that you've been in business for longer than that. Right? When you're going through a business loan application, a credit card, and a lender looks at you and like, oh, you just registered your company last month. You're like, no, no, no. Here's the proof that I've been in business, right? Here's a bank statement. Here's my fictitious business name, documentation, etc. Does that make sense? And so that's the proof that you are able to age it, and now you don't have to then start over as a startup. Does that make sense, guys? All right, S corporations. So, owners here. So in the S corp, you have a couple of different ways. Over here in the moment, you have a K1, essentially your distributions of what you make. So if you have partners or ownerships, the net profit can be distributed over the amount of partners throughout the company. And typically you have to have like either a W-2 or payroll. You can pay yourself either like $1,000 a month of some sort. So you have to pay yourself as an employee. It's not really good for investors. So if you're raising capital, this is not really the type of corporation that you want to go, because the max shareholder is about 100. And the shares only gets taxed when dividends are paid out. Okay, so a little bit of that element. C corporations is very, very common for investors. So they pay their own corporate taxes on a form called 1120. The individual shareholders will be tax gain on their personal returns when dividends are issued to them. Okay, so C corporations don't issue K1s to shareholders. Instead, they form something called a 1099 DIV when dividends are paid. Okay, so a little bit of a difference between a C corp and an S corp. A little bit different depending on its use, as we all are very common with our LLCs. So the partners can file taxes on their personal returns. And it could also be, essentially it's kind of labeled as a managing member of your LLC. Now, if you can be an LLC solely a sole member, if you're just one person, you could also be an LLC and be a S corp as well, where the income is passed through each member from that, which is the most common classifications that we see, from over here. I think that's a lot of people we've been dealing with, especially in this community, had their LLCs. Right. So number one concern from any lender is that how are they going to be able to pay us back here? Right. So when we're looking at the financials, lenders are asking themselves, what's the primary source of repayments? So typically, personal income or cash flow from the operations is relied as the primary source. Secondly, the lenders are looking at the owner's income or liquidity outside of the business assets. And then the third is the final source of repayment is typically liquidation or collateral. So, most banks are going to go through all the documentation. They're going to see really what's to determine the historical cash flow, that allowing them to see if they can pay back the loan. So banks don't want to own whatever you're buying with this loan, right? If you bought an equipment or a truck on the business, They're not in business to be able to go out there and try to liquefy that equipment or that truck so that they can get their money back. They want to look at the cash flow and how the operations of the business has been going to really make that main determination. And so there's a different mindset for how these banks, they look at these first, second, or third, options here. Does that make sense?
Yep.
All right, so tax returns over here. A lot of people look at the gross, essentially is 1A. And then the net after all deductions is on the bottom here. Okay, total revenue and net profits. So how do we determine your loan amount? Then they're going to be ask you, hey, can you afford this loan? Right? That's your potential, right? It could be 25,000, 100,000, 150,000. But do you have enough cash flow in your business to afford this loan? Okay, so if you look at this example, this person made $975,000. But if you look at all the different deductions, cost of goods, all the different excuses of why the him, but you look on line 30 on taxable income is $5,000. That's right. Great revenue. No. Essentially, you wrote everything off.
They want you to get funding with $5,000, guys. But you see this stuff, bro. You see this stuff
every single day. Every single day, guys. This is essentially one of the biggest killers, especially when you're going, when you're going for the bigger amounts of loan amounts. It's, banks want to see, tax returns a lot of times.
Yeah.
But if we stay under this certain thing, that's why we like to look at those low doc programs of 3 months business bank statements where we can coach you a little bit effectively versus having to wait for the whole entire year to close, get your tax returns. So a lot of it is strategic based upon the year where you're at. Did you file? Did you not? Right? It's all about strategy and how we can optimize for that other picture, though. But yes, you cannot get approved for a $100,000 loan amount when you just netted $5,000, right, for the whole entire year. So maximizing your expense deductions can significantly hinder your ability to secure business loans. So I always say, know yourself, know what you want to do 2 years ahead. If I'm cash flowing and I don't need to use the bank's money, yes, work with the CPA and go ahead and lower that tax bill. Because I don't need to use the bank's money. I got too much money coming in for my business.
Yeah.
But if you want to use the bank's money and leverage that, there's a secret formula that they want you to have, right? I'm gonna disclose what that is here shortly. So writing off all your expenses to qualify for business loans is like emptying your water reserves before a long desert journey.
That's
It might
great.
feel good initially, but it leaves you unprepared for challenges ahead. So who do you want to be? The person on the right or on the left? Which road do you want to take? All right, moving forward. So here's a little bit of a financial hack. If you do have interest and depreciation, it could be rolled back into your profits. Okay, so the loans that you're taking, or if you have equipment, you can depreciate that, even real estate over here, right? You see everything in green, interest, depreciation of 42,000, 103,000. You add that with the $33,000 in the net income, which is what they're paying taxes on, $179,000 in net income, from that. Pay taxes on your 20, 30%, however that's framed with your, I'm not a CPA or anything like that, but that's very little on close to $750,000 worth of revenue.
Yep.
And so these are little different small things that you can implement in your business on getting approved and having a low tax bill. Okay, so really, really work with your CPA. And again, your CPA, they're going to be wanting to deduct as much as possible. But again, they have to have a financial strategy on it, right? They clearly are about what we want. The faster it is for us to get there. If we think general, we get general. So which one do you want to be, right? Guy on the left, person on the right. Right? Very similar net profit if it was by itself. But again, you're getting qualified for the return on the right, when you get to that stage. All right, demonstrating free cash flow. So it's a general rule across all the loan programs and financial documents, right? Even your bank statements, tax returns, even no docs. Okay, and so there's a formula with it. What they look at If you're going in no doc or you're going off projected things of nature, but you have a lot of business debt, that could also go against you if you're not, calculating it correctly. And this is the formula these banks use. It's called your debt service coverage ratio. So essentially, is your net operating income, right? Your interest, depreciation, there's other elements of cashbacks, and your total debt service. Essentially, for every $100,000 you want to borrow, you need to show around 125,000 in net income. So if you look at your gross revenue, right? If it was $1 million, 10% of that on average is $1 million, and 10% of that is 100,000. It's the potential loan amount that they'll approve you for. So with your interest, depreciation, some elements of cash back, and then your net income, right? That other example of that tax return I showed you with 179,000, that would qualify for here, not the one on the left. So your business debt versus your business income, in simple terms, is about 12.5% of your net income, right? Including your debts, right? Your monthly obligations with your debts, et cetera. So when you look at your current position, and then you say, hey, I'm going to go ahead and add that new 50, 100, 150,000, even for equipment, any type of loan, this is actually a formula that they use in all commercial lending. So your current debt services, and then if you add that new loan amount of 100,000 with a 8-9% BLOC, 5-year term, etc., what that monthly payment is, they're going to add all that together, and they're going to say, are you at a 1.25? Or are you less? If you're like 1-to-1, that means you don't have enough free cash flow to do that, to qualify for that loan. And this is a prime example of one, banks want to know your business debt schedule. What are all the business debts that you have? So if you were one of the people that took out your SBA EIDL loan, is a 3.75 interest rate at 30-year note, which could be very, very inexpensive. It's like $600-700. Wow. Then you have a Wells Fargo, a line of credit, unsecured, $600. Your B of A, right, $2,000. You have an equipment loan for $1,000. But then you look at these MCAs, right? That $50,000 MCA is going to be costing you $10,000, $11,000 a month. So which one would you want to be able to get rid of first to get you in line?
So with Marco's situation, without getting too personal and throwing his business out there, everybody knows that of the MCA situation, of you taking him from 250,000 in MCAs all the way down to about 125,000 through your connections that you helped do. Tell the problem with what he had going on with MCAs, right? So that way it really lands with people. Because when a bank's looking at all those MCAs, right, he's really going off of his cash flow for his business. That's how he's establishing his credit. Remember, capital, cash flow, right, collateral, or credit partner. Those are going to be the 4 ways, guys. So he was going off of cash flow, right, because the credit wasn't there. So the cash flow's there. He's basically becoming a slave to the MCAs, and he's got to pay those off, and he's paying high interest, and his profit margins are slipping. So the whole goal is to get him out of those horrible debt products that have been maintaining him, reduce that amount, so now we can actually go get him business lines of credit. Is that correct?
Yeah. So the first thing we have to do is go in there and see, number one, does Marco qualify by himself, right, through the whole thing? How's the business? Does the business have any challenges or derogatories, late collection, charge-offs, whatever? And so a little bit of the element is that we had to look at a credit partner, looking at a different company. Like, luckily he did have other companies.
Yep.
And so
he just said in the chat, guys. He said in the chat he was paying $1,500 a day. Imagine that being you. Right. Shout out to some of my favorite Mexicanos in the building. Like, that is a lot. I can't imagine paying $1,500 a day. That is a lot. Like, guys, imagine he's got a family. He's running a restaurant in commie California, okay? Communist California.
So, Mark, are you okay if I kind of talk about the strategy that I created for you? Okay, cool. When I looked at Marco's scenarios, that he did have a credit partner that had good credit, et cetera. I said, hey, do you have a credit partner at all? He said, yes. He had one or two people. Out of the two, we chose that one that he secured. I'm like, cool. We have somebody that can be, the face of the thing, right? Your company's a car, switching out you as a primary driver to the passenger, putting the credit partner in that section here. All right, number two, his current company had some derogatories. I think it was an old charge off or something or late. And I said, okay, well, no matter what, right now, your company as is kind of toast. I can't do anything, even if we have a credit partner at that point.
Mhm.
Not saying you have to throw away the whole company, but that derogatory has to season and let some time go by before that gets reestablished with the business credit, et cetera, because you have all these UCCs, 4 or 5 different MCAs, et cetera. But luckily, he did have a separate company. Again, the name of his restaurant doesn't have to be his LLC name.
Mm.
Okay. And so you can create, and he had 2 or 3 other companies. I said, let's use that company, create your DBA it matches. Let's take the merchant account, qualify for another merchant account for another company. So now the revenue is not flowing from LLC A, we're flowing it through LLC B.
Mm.
So the merchant account, all that money that's going through is going to be built up another one. Then you're going to take the revenue, enough revenue, so that we can then service the debt for LLC A. That makes sense so far. A little
Mhm.
more advanced.
Yep.
So credit partner, put them into LLC B, build that up, get 3 months of business bank statements on a
Mm.
clean, built up element, get some business credit, et cetera on that. So now we have 3 months of business bank statements. We have free cash flow flowing through. And that was my essential high level, the solution on how we can get him, right? If he's doing close to about 1 million, something like that in revenue, that's 100,000 per bank. Go to 4 or 5 different banks, so you probably get them $500,000. All right, guys. So personal tax returns, right? Very, very similar aspect as I mentioned to you on the person on the left. Your adjusted gross income is what business owners of lenders look at for your fundability. So if as you can see, other income, typically from your Schedule C, if you make a whole write-off, carries over to your personal, that carries over down. So you can see he had a wage earner of 51,000, but then he had a major loss with his business. He lost $103,000. You're not going to get approved for a mortgage or any type of personal loans or at all, right? So person on the right, $98,000, from there. So what's good? Very, very self-explanatory. So debt to income ratios essentially is your average amount of expenses, typically divided by your average amount of monthly income. You want to be around a 35 to 40%. So if you have $4,000 in your monthly expenses or $10,000 in your monthly income, divide those two. In mortgage, they're going to look at the last 24 months and have that average. If you need to, there's only 2 things you can do here, right? Decrease expenses or increase income. By doing that, you can then add a joint borrower, right? If you want to manipulate the way we do it, especially in the mortgage industry from there. All right, so moving forward, your UCCs. Okay, so UCC liens are used when a creditor wants to give you notice to other lenders that the interest is in the debtor's property. UCC 1 financing statement is generally filed with the debtor's Secretary of State when a loan is originated. Right, they can attach the UCCs in a wide range of assets, including, inventory, equipment, real estate, vehicles, accounts receivables, investment securities. So essentially, this is like a lien on public record of your business, letting somebody know that, hey, I have secured some type of assets from that. Now, it could be different types. We're going to get into that a little bit later on. But you want to stay away from these type of companies for lines of credits or term loans or business loans. They will file a UCC even though it's unsecured. So Maurice asked, what's so bad about UCCs? It's not the fact that it's bad about they're bad essentially, right? They have a use, and I'm gonna get into it right now. There's different uses, from it though. But when you're doing our credit hacking element where, like, how did I get $1.3 million with about 17 different banks? I went from one to another, all 50, 100, 150,000 underneath the threshold of the UCC requirements for every bank. But if I have that UCC being placed on that, if I go to the next lender, they're like, hey, what's this? Oh, we don't like to be in second position. So you need to pay that off first. And we want to be in first position, because what happens when you have these UCCs, what is actually a good point to my next slide, is that you can have UCCs with specific collateral, kind of real estate or equipment. There's another one called a blanket UCC, which covers all your assets. Very common for SBA, or if you're going larger loan amounts, some of the different thresholds of 150, 250,000 or more. Accounts receivable factoring, purchase order factoring. These are all different types of lenders or loan programs that will cover the whole entire, assets of your company. So it's going to prohibit you from getting more by having those. So that's why I'm a firm believer of going maybe a little bit less, but then I can go in quantity to do that.
100%.
Okay. So reducing the bank's risk, right? If your credit isn't perfect, right, putting up collateral can reduce the risk, Russ, thus approving you. So if you had some boo-boos on your personal credit, but having that real estate or anything that you want to pledge can give some security to that to that lender, right? And so it's just about looking at the whole entire picture of what you're looking for and what you're going to do with it. But if you are able to provide collateral, right, they'll go for it. So if you have a UCC and it got paid off, you have to make sure that you check your business credit report. Because a lot of times I've had clients that had 3, 4, 5 of them that were paid off. Before I was able to go in and get hit, one of my clients, I got about close to about $500,000, but I had to go and work some surgery on optimizing his business credit, and I had to make sure that he went to his lenders to get a letter so we can then update the element. But you can file something called a UCC3, which terminates it from the Secretary of State. You have to submit it to your lender to get that done. Okay, so you have to be on top of it, right? Just like you're on top of your personal credit, it works very similar to your business credit as well. And know the rules of the game before you play, right? Understanding how this all works allows you to make smart decisions moving forward. Make sure you get approvals after approvals after approvals. Moving forward now, national expansion. How the art of foreign filings to maximize your lending opportunities.
Dude, you're getting good with these AI. How many people think that Anthony's an artistic soul? Look at this. He's running the dolly on steroids, man. Like
I had a lot of fun.
New York
I
is
had a
kind
lot
of
of
messed
fun.
up,
I'm
though.
like,
why is New York and Montana, bro? And why is this? That's a little weird, man. I think
so when I looked at it, I'm like, that's kind of odd. Why is it doing that? But then again, I asked it to provide me a representation of foreign filing. So if your domicile is in New York and you want to move your company and foreign filing into Montana, I'm like, man, California's not in Texas. What is this?
Where's Ohio at, bro? Where did you put? Where is Ohio?
I didn't put Ohio. Chat did. All right, let's move forward.
I love
It's
it.
interesting because sometimes that you can see like setting it up of business multi-talented. I'm like, come
Dolly's
on,
still
Chat
learning.
G. Dolly, please fix your spelling. You're not 3 years old. Let's go. All right. So what is foreign filing? Right? It's the process of registering your business in other states than other than the one that you're currently incorporated in. Right? This is what we call foreign filing. Right? It's kind of like foreign qualifications is like, qualifications for a business is like getting a driver license for a new state when you move. So just like you need a valid driver's license to legally drive from one state to another, as you're moving, the business needs to register for foreign qualifications to legally operate in a state other than it was originally formed. Okay, and this is how you can expand your lender network from where you formed a company to the next one. It's really simple to set up. You don't need to pay, your legal Zooms, your court nets, and there's a thousand other ones out there. But if you just go into Google and says foreign file in Florida, right? Because I'm here in Miami, you can see it gives you a lot of information on what to do. You want to essentially go to the Secretary of State reference, right? And just be able to register your company there. You do need a registered agent, essentially somebody that can accept documents on your behalf. You know, if something happened, if you get sued, they need to have somebody who's representation. But if it's in your own state, you could be your own registered agent. But if it's in a different state, you need somebody. And don't confuse that, oh yeah, I'm in Wyoming and I'm going to use the registered agent address as my business address because it's not the same. I've had some clients, tell me that before. So you have to get into your corporate compliance, right? So if I'm in Miami and I am registering it in, a different state, I'm going to need to set up the virtual address or brick and mortar. Make sure the virtual address doesn't have anything associated with fraud. But the fact that, a lot of these challenges that we've been facing is that if you're in a location, even a Regis or an OPA, all these different other companies out there, but if somebody did fraud, it's going to be on Google, and a lender's going to look at that, an underwriter, and that can then kill your loan because that address was associated with some fraud in the past. And they don't go next to that. Does that make sense? So you have to go through the same exact corporate compliance structure that I've been teaching you. Online, update your online presence, local listings, websites. So if you have two different locations, you have one in Miami and I have, let's just say, one in Vegas, I'm going to put that on my website because I'm proud that I just expanded my operation. It has to make sense, from that. So you need a good story of why you expanded. Okay.
Yeah. Yeah. And that's what they're not telling Anthony. They're not telling people that. They're just saying, oh, just do a foreign filing and do key bank. Like, bro.
So now the question is, if you go through the details, right? The devil's in the details, right? You're gonna need to look at, okay, well, if I'm in Miami and I have a Florida license and I have my new location in Vegas. So if you're able to get a state ID from the state that you're foreign filed in, then it does make the whole story a little bit bigger. I'm going cross between Vegas and Miami. That's how I'm able to operate the whole whole thing over here, right? So when I was living in California, I had a state ID, but in my driver license I had in Miami for over 10 years. Okay, and at the same point, I was able to get an Arizona ID, which it's kind of crazy because that never expires. I literally still have it. It's like 10, 15 years ago, and I still have that from that time. But it allows me to, hey, if I want a foreign file in Arizona, I can show that I have a physical address over there. It just essentially it helps with the whole story of, working the system in the foreign filing game, which, hey, you can use your state ID if you know somebody's address, right? Fly in there, go and get that. You can have as many state IDs. You can only have one driver license. I learned that the hard way when I got my global entry, and the custom homeland security officer was like, you got a driver license in California and Florida? I'm like, yeah.
Oh no.
Is that
Oh,
not?
no.
He's like, no, man, you can't have two. I was like, okay, cool. I'll go and kill the California. Thank you. Well, yeah, it's okay. But so when I was living in California, I maximized all the banks in that state. It was a great funding states, but again, not so great for taxes. Then I set up shop in Miami, in Florida, and then now I worked all the Florida banks. So I got the best of both worlds, right? And that's kind of how I was able to leverage my banks out there. Does that make sense?
Mhm.
Okay, so after you've executed your funding rounds in your states, be able to look at, hey, how many banks can I go to? Create your funding plan, maximizing your Pennsylvania banks. I'm not sure if you're here or not, but you're looking at strategically, hey, do I want to go in Texas? Do I want to go in Pennsylvania? Northeast, right? West Coast, where in the middle, right? Do I want to be at? And so let's be strategic about knowing the 2 steps ahead of the road. Yeah, so you gotta make sure, right? There's pros and cons to all this, but looking at the state tax implications, yeah. So if you hit a certain threshold of revenue, then you could be taxed in that state. And
Mm.
so this is a site that I found that I felt if you want to take a snapshot of this, where if you're going to play the foreign filing game, and I believe what's his name? Dennis Thorne, when I told him about the foreign filing aspect of it, and he wanted to expand. I think he went out into like 20 or 25 different states, and he just foreign filed with everybody. Uh, but know those rules, right? So there's certain thresholds that if you hit 500,000, California enacted legislation that raised the sales threshold and removed the number of transactions on the 25th of 2019. Okay, cool. So if you're in there just to go ahead and get bank funding, dissolve it right after, hey, I'm for the people, not for the banks, right? Be the Robin Hood here. Do not care. So I feel like it's the best states for foreign filing. Delaware is great. Nevada, Wyoming, Texas, Florida. Essentially, you you want to look at certain, the pros and definitely the costs, the cons, right? So Delaware is great, but they have a pretty high annual franchise tax. Very common for like investors, but great for being anonymous. So if you're doing the whole foreign filing, especially when I'm going to get into the aged corps, a lot of this is going to matter for how you're getting yourself set up. But these are all great states. Age or shelf corps. Should you or should you not invest in one? Right? A shelf corporation is also known as an age corp, or a shelf company is a corporation that's formed but not actually in use. Right? And just like it says, it's been sitting on the shelf, not doing anything. Right? These entities can have either your EINs, can have years of filed tax returns, and somehow even have bank accounts from the past. So think of it like you're doing a business acquisition. So a lot of these, there's a lot of scammers out there that are just reselling old corps that have been dissolved. So you
Uh,
really have to make sure all the stuff that I'm gonna teach you next week makes sense, right? A little more of an advanced level. So you may have to watch this recording a couple times, but again, the more information you can understand and implement, right? That's really the key here, and that's my goal for you guys. So formation coming formed in states with tax benefits, anonymity, and low filing fees and regulations. You always see a lot of them in Delaware, Nevada, Wyoming, Texas, Montana. I've seen a lot of them as well in Colorado, New Mexico. Same point, but they can run anywhere from as low as 650 all the way to 10,000 or more, depending on
mm.
the age and the perceived longevity. I've actually even seen some either around 20 or 20 to 30,000. And some of these people, I think, what was it called, like Beverly Hills Corporation or something. It was they were trying to sell even tax returns and business credit. This whole entire
Ouch.
thing, honestly, it's the biggest crock of shit that I
Uh-huh.
that I that I've seen. I'm gonna actually show you an example here. There are some benefits here, right? It allows new or small business owners to appear as an established business, right? Saving time and expenses of forming new companies, new corporations. It can help you apply for certain contracts, government bidding, gain investors' trust, and secure business lines of credits with an established business versus being a startup. Typically you need 2 years in business for all the major banks to look at you. And so that can be your shortcut to do this. However, there's pros and cons. You just have to make sure that you're safe, from that. So you have to be caution. A lot of fraudsters out there that are selling you things with past liabilities. It could be, legitimate reasons. There should be legitimate reasons for purchasing a shelf company, not just by, manipulating credit system isn't just one of them, right? The best thing you can do is just form 2 or 3 companies. Yeah, if you're operating one, just have one or two. That's what I did, where I had two other companies that were sitting there, and I have my main operating account with all the cash flow and revenue was going through, but I had one other one that was the backup, another one was starting for my tech company. So again, time flies and there's ones that are out there, but you have to be careful with people like this. Okay, because these are the type of people that are going to come and say, look, I'm going to get you up to $500,000 with a ready shelf corp.
Guys, these
Steady
people do
income,
that
no tax
all
returns,
the
no
time.
collateral. So I say these are one of the biggest parrots of them all.
Parrots. Yes.
Parrots
Yes.
on steroids.
Yes.
Right. And so a lot of these people are trying to really, really con you, right? You see that $500,000 flashy information. I don't need to provide anything. No, dude, it doesn't work like that, guys. You need to be able to really set things up properly, from again, but there are pros, right? Bypass the minimum 2-year requirements, potential to get larger business lines, B-locks, term loans, access to contracts and bidding opportunities, depending on what your use of funds is for, and your business, enhanced corporate image. May look like a little bit of a bigger company, right? Cons, potential legal and ethical issues, unknown liabilities, right? The cost would be a lot more than it was if you establish it yourself, lack of business history, reputation risks, and company complexity due diligence, right? At the same point, there's no guarantee or credit for doing this, right? You're not going to be guaranteed getting funding. Essentially, I remember because I've set these up for clients in the past, and unfortunately, um, my experience has always, I kind of stopped doing them. Again, I know how to do everything, right? The good, the bad, and the ugly. And setting these things up, the one of the reasons why I stopped was that these people were just trying to trick these lenders about what they were doing just to get funding, and it just didn't really seem the as more ethical, and just the quality of people that I was dealing with weren't very like strong business people, right? And I just said, look, I'd rather deal with somebody that has a real business going through and actually needs it versus trying to do this whole facade, from it though. But even at the point when we were establishing a business credit from Duns and Bradstreet, there's a lot of these minute little small things that if they catch on, this was a shell cord.
What are the minute little things?
So when we went to go and establish a business credit with Duns and Bradstreet to get their Duns number, and we had, it wasn't working, so we had to call it in, and the the Duns and Bradstreet representative was like, "This is a shelf company." Now that guarantor, the owner, was locked into the D&B system, which now any other company that he was going to be dealing with, that red flag was going to follow him. You're going to have to look at the business credit report, right? Or the tax liabilities. If there's a tax lien and you acquire the company, guess what? That's your tax lien now. Or
How many people
lawsuits.
want to take on other people's shit? That's like catching an STD. Do you really want that? Creditchlamydia.com. You better be careful. You better be careful, people, before you catch some shit out here in the financial world trying to get a hack, trying to get a shortcut. Anytime you hear about a hack, it's probably something crazy. Stop cutting corners and just build out proper business credit. Everything you need is in this program to build out proper business credit. You'll get there. You'll get there. And focus on revenue. Because when you really bring in revenue, then Anthony can just throw all the fire on it.
Oh, good. But again, if you still want one, all right, here's my tips on how to be able to set things up. So do your due diligence. Number one, you want to buy from a trusted dealer, not a parrot on steroids from some of these shady people. If you sign up with this, if you register with this businesscreditreports.com, you're able to pull business credit on any company.
Yep.
And so
Without their approval. Without their approval, because
that's
that's a
correct.
different
It's the wild, wild west with business credit.
Yep.
Right.
Yep.
And so I'm direct with Experian and Equifax. I can pull business credit through my account. Again, this is a third party site that you can do it yourself. So if you were going to buy from this trusted dealer or anybody in case, and they're like, yeah, I'm going to sell you this shelf corp, pay $56, get the Advantage Pro. It'll combine your Duns and Bradstreet, Equifax, and Experian. I think even credits, if I'm not mistaken, all in one. So you can see in a peripheral view if anything has ever been established on this report, on this business. Okay, so that's the first thing I would want you to do. Once you find the right company, you want to make sure that you choose the right corporate name. If it's XYZ trucking, well, again, you box yourself into the trucking industry. The more subjective you are with your name allows you to be flexible in what you want to do. It doesn't matter what your website, your website can say something, the corporate name powered by, X can be something else. So again, you want to be able to make sure that you choose the right name that's subjective. Then you're going to go through the same exact thing that I've been teaching you guys, right? The business address, phone number, 411, yellow pages, local listings, online presence, Google, Facebook, Instagram. Take some time over here, right? Get your EIN, registered. But here's the difference here. If you're looking at how a bank reviews, right, the metadata of your company and your website, right? Remember I told you that Citizens knows exactly when you created your email address. So you want to make sure they're going to something called a Who's, which is a domain lookup. And if you just bought this 3, 4, 5-year-old corp, and then you registered a brand new website, right? A little bit of confliction there. There's a story that you have to go overcome.
Mhm.
Does that make sense? Right. So, okay, cool. You've had this company been operating for 5 years, but you just created a website last month.
Looks
Red
fishy.
flag. That looks fishy. Denied. So the hack around it is to get an aged website. Okay. And we found a company that we refer our business to called Business Funding Websites. And the people that do want it, because we do have the resources on how to get these. Convince me why it's a good idea to do it, because I want to provide you my honest opinion, because
Yes.
I'm always raw and real about what's the best way of doing it.
Yes. What is the good reasons? What are good reasons to have an H corp, Anthony?
Marco's situation.
Okay.
He has a company,
Yep.
right? Ran into some trouble. He has 3, 4 MCAs. Something happened with the business credit. He's not going to be able to divert that to get business funding because of how his current business is looking. It's going to be a lot harder to do that. So he has a running business, taking that shelf company, working it, building it up, having the revenue flow through the other company, doing that for 3 months. That's a good use case of why I would do what I would do here. So still want one? You got to build business credits, register your Duns and Bradstreet, apply for your 3 to 4 vendor accounts, obtain your ADPX scores, right? As I mentioned before, if DMB finds out about your age corp, it could hinder you. There are certain other aspects of the purchase business trade lines. And again, I know all the people and know all the sources. Essentially, you're going to be able to get like a 30,000 Experian reference on a business credit report with a 50,000 SBFE. It's going to report to them. They're going to be added within 30 to 60 days. They're not cheap. In the industry, they're going to go around 2,500 and up. Of course, if you want a larger one, it's going to go up from there. Right. So there's a little bit of the shortcuts for how people use this. They get the age corp, they build it up, get the age website, they add the aged business trade lines, from lines of credits or term loans. I actually remember having, and again, little small things that somebody came to me with, who bought these aged business trade lines, and they added a term loan, and they put the term loan as like, I think it was like 100,000 term loan that they added on the business credit. I had the potential to get this person about $300,000 to $400,000, but they made an error on this. $100,000, $100,000 or $200,000. I forgot which one it was, but the monthly payment that's being reported on the business credit from that purchased business trade line was close to about $8,000 or $9,000 a month. What do you think happened to his debt service ratio? Right, that 1.25 ratio. So he was making good money, but that trade line had to be closed because the debt was too high for him to qualify. And he accepted one loan, so we had a UCC being put on. We were rushing to get that updated, and he lost $200,000, $300,000, $400,000 because of that. So again, cause and no effect. But if you do a line of credit or if it's closed, it will help you in the fact of increasing your approvals, 3x on approvals, higher loan amounts. but that's just one of the components of the 4 pillars that I'm teaching you. Okay, so it's giving you, the total vision of how this all works. Opening up a bank account if you run to 3 months with the business activity, right? Create your funding plan, submit, and going from there. So that's kind of a little bit of the peripheral view. A lot of the principles that I've been teaching you, you have to implement into that. You want your checklist, you got to go through this whole entire thing. Right? Not easy. So if you're going to do it, you got to do it properly. Don't think that you're going to get your H Corp and a month later you're going off for funding. You're going to get your $500,000 just like that one website, goes through. So know the rules of the game, review and understand your 4 pillars, and then implement it into your business. And again, your finance team can make such a big difference over here. I had a quick question, real quick poll. How many of you guys right now have a bookkeeper that works for you? Put a 1 in the chat. How many of you have a bookkeeper that works for you, that's helping you with your bank accounts, reviewing it, reconciling it, putting it into QuickBooks or something similar? Only 5 people. So at minimum, right, the clearer we are about what we want, the faster it's for us to get there. But if you don't know what your current financial position is, it's really hard for you to be able to predict what's going to happen if you don't know where you're currently at. So
how does having a C-suite team, and I know you'll talk about it, but how does having a team help people get more funding?
well, when we look at what I call the wealth triangle, right? If you're not making at least $120,000 in income in your business, you need to invest in yourself and learn certain skill sets. So when you go to the next phase of your business, which where people and systems start making you money, that's where your C-suite, essentially what a C-suite is, it's your chief financial officer, right? The one at the very top, your chief marketing officer, your chief financial officer. So I already said that, your revenue, operations. So these are all the entrepreneurs who are handling a department into your business. So you don't need to be the expert at everything, right? Like I am not a marketing genius, but if I have a CMO, they need to be good at that role. I'm over here, the visionary, right? The CEO's job is to always make sure that you have enough money to fund your business. Number 1 job. Do we have enough money to run the business? And so funding can hire the right people, which allows you to free up your time because you're not having to learn how to do marketing. You're not having to learn to do operations, right? I know enough to be dangerous at every single department, but I'm not a specialist at being a CFO or ops. My CTO is the one who is handling my 10 developers on building the technology. Do you think I know how to code? Absolutely not. Nor do I want to. But I'm hiring the right people so that they can do that job. It's my vision that we're programming. That's what matters. And so it's just like a mastermind, right? Everybody gets together for the common goal of achieving an outcome, and we're all contributing to that outcome. We all have different roles. That's the beauty of your C-suite. So that's what happens when you become a business owner, where I'm not having to be involved in 15 different roles in my company because I do have my chief operations, CFO, CTO, right? Looking at what your business is and what is the number 1, number 1, 2, 3 different hires is going to help me move the needle. Okay, hopefully that makes sense. But more of the business advisory elements, but there's a little bit of a difference between the two, is that how much farther can you get if you're the one doing everything in your business? How much is your time worth? Have you ever quantified if I had to look at myself and say, hey, if I'm worth $1,000 an hour, how would that change your decisions on what to do next?
Yeah.
Should I go and do the books of my company that I can pay somebody 20 bucks an hour, 15, 20, 30, 50 bucks an hour? If I spend an hour, I just lost $950. Different perspective. So value yourself. And then based upon that, you can make certain decisions of, should I do that? Should I go run that errand?
Mm.
I'm going to lose $1,000 if I do that. Or can I put that energy into something, into my business where it can really make a big difference to move it to the next phase? So this is why it's important, right? When you're starting a business, if you don't know how to do something, you hire somebody, you joint venture with somebody. There's no excuses, even if you don't have any money or credit or anything of that nature.
Yeah.
Find people that you can partner up with that can solve that particular problem. I got that from Jay Abraham, right? Guy's worth like $20 billion, number one marketer in the world. All right, so let's go to some CDFIs. So it's an organization dedicated to helping people in low income communities and to people who lack access to funding, right? It's more of a government program. They help allocate a budget for that.
Hold on. You see, guys, see that it says the Department of the Treasury? Guys, you see that where it says the Department of the Treasury? Yeah, you guys got to know about this one. Yep.
Okay. So the CDFI is not a lender themselves. They're an organization that helps with other lenders. I think there's about 1,400, I believe, organizations that you have access to. So I did a little bit of a quick video demonstrating how you can use this company. If you can go to this website, ofn.org, and this is essentially a CDFI. Can you guys hear this, by the way? I just want to make sure you guys can hear this. So yes or no? Yes? Okay, cool. Locator for all the different organizations that help you in your area, right? The CDFI is specialized in lenders that bring capital to low income, low wealth communities, provides from business, affordable housing, a lot of those different types of facilities that the government has allocated for your scenario. So you come over here to the menu, go to CDFI Locator. Now, I want you to scroll down and go to this section, right? So I'm currently in Miami, so I'm going to check Florida, and let's go ahead and business. If any of these pertain to you, you can go ahead and search. I'm just going to go to the max filter. You can see that better. So you can just go through each one of these websites and see what the requirements are. Everything that I've taught you, right? Know the rules of the game before you play. What's the UCC requirement? What's the minimum credit score? All of those elements that you can start asking when you speak to either a banker or a representative and see if it's going to fit your profile, right? You can see this company serves a lot of these states, and you give a little background. Let's just go to their website. So I send this, go here to find funding. You're going to see all the programs and what they offer, right? Small businesses from 500 to 50. Let's go here. Microloans, right? Great interest rates. Qualified businesses nationwide, except for Vermont and California. Sorry, Cali. You're asked that on this one. Look at this. You need 6 months of consistent revenue, minimum 575 credit score. Thin credit, no more than 3,000 and unpaid. If you've been in bankruptcy for 1 year, more than 1 year, you can now get up to $50,000 with these people and foreclose for more than 2 years. So you can see how powerful it is, depending, of course, if you're a minority, if you're a woman, people of color, all of these things. There's a section for every one of them. So let's go back. Now look at this. If you're in New Jersey, up to 150,000. Connecticut, care business. That's some of us over here. I've spoken with you. Rideshare business terms. All right, Uber and your Lyfts, most likely. New York, my New York people in house. Just go there real quick, because I love New York so much. All right, existing 100, no more than 100 people, 5 million, up to 150,000, no prepay. Look at these things. So you want to call figure out what type of requirements do they need. Entrepreneurship of color fund. 575, 600 for 250, 2 years in operation, 51% must be an entrepreneurship of color. Do you know how crazy this is? If you need equipment, please just go through here. Access business line of credit up to 25, fast track with minimal paperwork to require. Minimum paperwork required. If you're in these states, 625 credit score. I mean, doesn't get any better than that, guys. So no FICO minimum. Probably a credit building, opportunity here. So, again, going through some of these things, look at this. I think this is for minority owned, $150,000 to access our funds. They do mentoring and counseling. For instance, 100,000, 8% fixed. That's even lower than the prime. Or 5 years, existing in startups. You have to be in these counties, estimated 4 to 6 weeks. And so if you can use ChatGPT, create a business plan, have your projections, right? You might have to do a little bit of work to prove to these people that you have a viable business. It's not just some fly-by-night age corp type of kind of element, but you can see that there's a lot of different little gems. SBA, to New York, up to 100,000, emergency, up to 50,000. This is amazing. I'm actually going to be tasking my staff to get and extract all of the CDFI lenders, what the requirements are. Then we can then also enhance our lender list and help you guys get there a lot faster. So hopefully this accounts. Go through your city. Make sure that you talk to a representative, ask all the questions that I have taught you. This might be another solution other than your regular bank funding.